Great. Welcome to Digital Asset News. Pick a top stories in crypto and break them down to bite-sized pieces. Today, instead of talking about the news, I think we should talk about something a little more important, which is also the most tedious and boring that for some people, but it's not for me and Shehan. It's taxes. So if you don't know, this is Shehan Chandrasekhara. He is a legitimate CPA that specializes in crypto and digital assets. Shehan, welcome back to the channel.
Yeah, thanks for having me. Good to be a participant this time.
I know you're busy because everybody's gearing up for taxes and things like that. You can follow Shehan over at the Crypto CPA. There's a link in the description also. But I want to show you, these are the outline of what we want to talk about today. So first of all, let's go over this. There was a Portugal article, and when you actually get taxed for crypto, it's going to be like a general 50,000 foot overview. Then we're going to talk about staking and taxes in this recent lawsuit that came out. That's being fought right now. We're going to talk about, and this is what I was curious about, virtual land versus physical land. Can we use depreciation, 1031? How does that get taxed? Because I don't want the IRS to beat on my door. And this is, for a lot of different people. Also, you wrote a great piece on Web3. So I want to talk to you about Web 1, Web 2, Web 3, and how that relates to taxes. And is the government really ready to tax us in this wallet-based society, like what you said? And then lastly, we'll talk about tax forms, programs, and of course, everybody's favorite, how the heck do I minimize my taxes for the plan? Legally. You can tell us the illegal stuff, Shehan, if you want to, but we'll take the legal stuff. And then lastly, we'll do a little Q&A. So hold your questions until the end, please, because it's hard to go through everything. So let's start off, my man, with this. There was an article, and it was pretty good. It was with you and Diddy from the Bitcoin family about Portugal for 0% taxes. And the thing that you wrote right here, you must get like asked a ton of different to be in a ton of different pieces, because you're like one of the few like CPAs that delve in this. So you must be like super busy, no?
Yeah, I mean, lately, there have been so many reporters asking questions about, U.S. taxes and even, overseas taxes, and especially now we're in the tax season. This is a hot topic. So, yeah, it's been busy lately.
Yeah, I gotcha. So look, we're going to go over all this stuff, but I know some people, I was just perusing on the comments real quick. You guys are scared about taxes. I understand. We've got a couple of programs for you that'll help you out and make it super easy. One is Coin Trader, one is Crypto Trader. So we'll talk about that at the very end. It's super simple. So here's the thing. So here's what you had said. Portugal views crypto as a form of payment. That distinction is a game changer. And you said capital gains resulting from crypto transactions such as cashing out and crypto to crypto trades are not subject to personal income taxes. Did they quote you correctly? So capital gains from crypto transactions such as cashing out and crypto to crypto trades are not subject to personal income taxes. Is that correct?
Yeah, I mean, Portugal is one of those countries that has, super friendly crypto rules. So yeah, you can cash out your crypto, you can convert one cryptocurrency to another, and you can accumulate a ton of wealth, and it's not subject to their personal income tax code. So yeah, so Portugal are truly a crypto tax haven.
So we should all move to Portugal. Is that what you're saying?
No, I mean, obviously it depends on the facts and circumstances of each and everybody. I would, again, we can talk about this in a tax saving strategy scenarios. I would first kind of see if it makes sense for you to do anything in the first place. Yeah. And if you really have to save taxes, I think one of the easiest thing you can do is to kind of go to like a state with no income taxes before kind of moving your entire family to like an overseas country.
Yeah. So here's the thing. So in Portugal, when you cash out, you're not subject to income tax, right? But let's take the US, and for the most part, a lot of different countries. Let's say you bought Bitcoin at $100. Now it's, what is it today? $44,000, something like that. Let's say you need the cash. You cash out. You have it in cash. Is that taxable?
Yeah, that is a taxable event. So you pay the difference between the sales price and the cost cost basis, that's the profit on which you have to pay taxes on.
Perfect. Here's another question. I got Bitcoin. I bought it for $100. It went to 44,000. Then I take Bitcoin and I put it into USDC, which is a stable coin. Is that taxable?
It is taxed.
What?
Taxability.
No, I'm just kidding. Okay, go ahead.
This is a question that I get all the time. I'm pretty sure, Rob, you get it as well. Like, I never cashed out anything. I just went from Bitcoin or Ethereum to like a stable coin. Unfortunately, it is taxed because of the way that the IRS treats cryptocurrencies. IRS treats cryptocurrency as a property. Yeah. So in your example, I don't remember the exact numbers, but let's say you got a Bitcoin with 10,000 and at $40,000, you didn't cash out, you converted that Bitcoin to a stable coin. Right. You would pay taxes on $30,000 worth of gains.
No, that's awful. Okay, so now you know. So everybody, if you go into stable coins, like everybody talks about, you could get potentially taxed, depending on where you're from. If you're in Portugal, no big deal. Abu Dhabi, I think you're okay. Puerto Rico, move here for Act 60, no problems. But the rest of the places, different various taxes, and off you go. So there's that. Here's another question I get. Let's say that Tesla brings back the opportunity to buy a Tesla with Bitcoin. Let's hope so, right? So I buy Bitcoin for $100, now 44,000. I buy a Model X, a very cheap one, I would add. I'm just buying for a good. So am I taxed on that one, or do I get away with it?
It is a taxable event. So okay. Because you're expensing an asset and receiving another type of asset. And the trick here is that at the time you expense that asset has appreciated. So IRS wants you to pay taxes on that appreciated gains now that you're realizing by getting a car which is worth $40,000 to $45,000.
Okay, this is what we were talking about before. Everybody says the same thing about taking profits. They're like, I don't want to take profits. I don't want to pay taxes, right? So let's just say, for example, you buy Bitcoin for $100. It is now, hold on. Let's say you buy 10 Bitcoin at $100, right? You spent $1,000. Now you have $440,000. Okay. Would you take some profits out on that? Or actually, no, that's actually a pretty bad example. Let's say like this. You bought XYZ coin. It's $100, right? It goes up 25% in a week, right? And it's very unstable. You know it's going to crash, or you think it's going to crash. So now you've got $125. Let's just say. Would you take out any kind of like profits off that?
Yeah.
You personally, Sheehan, and this is not investment advice, just investment opinion. How would you do it?
Yeah. I wanted to say the same. This is not investment advice or tax advice. It all depends on your goals. I mean, Rob, this is what I've been listening up the show. It all depends on your goals, right?
Yeah.
Personally speaking, I would only cash out if I have something else better that I can do with that cash, right?
Okay.
I mean, what's the point of converting into cash and kind of costing yourself because there's inflation and stuff like that. So that's number one. I mean, if you were to cash out first, is that going to move the needle for you, or do you have anything else to do with that cash?
Yeah.
And then the other criteria that I think is that, like, let's say, you put certain amount of money and within, I don't know, maybe a couple of days or within like a very short period of time, it goes like 50, 60% gains. In my opinion, I would cash out because those are, very aggressive returns for the amount of time that you kept your capital in. So in my mind, yeah, it's worthwhile kind of taking that, little bit out of the table and just invest that money in some other coin. So that's how I would. I
gotcha. And just a little de-risk type of action. Maybe not the whole thing, just take it off. I guess that was a pretty bad example. $125, and you're going to pay 40% of short-term capital gains on $25. So you're going to get like 13, whatever it is. All right. So that answers that. So let's move on to staking and taxes, because this is the big thing that had just come out recently. And my thing is this: like, I stake a lot of my crypto, a lot, and a lot of those things are coming back. And now it seems like, well, all the gains that I got from the staking, Cardano specifically, now I could potentially get taxed. But there was this great lawsuit going on right now with this is a Nashville couple. I forgot their name. I think what was their name?
Jarrett.
Yeah, Josh and Jessica Jarrett. And they went all the way and they are suing the IRS. And I thought to myself, first of all, I was like, well, how can they sue the IRS? Because they're just a family from Tennessee, right? How are they going against that? And of course, in this article, let me blow this up so everyone can see it. They are being bankrolled by the Proof of Stake Alliance. And you know who's in that? People like Coinbase and people like Gemini and people like Facebook and Meta. They're the partial funder of the lawsuit. And what this comes down to is they're like, hey, how can you tax me on the rewards that I got from staking when I haven't even sold it? So, Shihan, how do we play this? Because it looks like the law is in place where they're going to tax you, but there's like a gray area. So how does this work this year?
Yeah, so I want to clarify that this is an ongoing court case,
Yes.
and it's not finalized yet or anything like that. So don't blindly believe the headings that you see on some of these articles. It's just an ongoing court case, which is actually very favorable for taxpayers. So I'm generally excited about this. So here, what they're arguing is that when you receive these Cardano, whatever the new staking rewards, these are considered newly created property. And they're giving some analogies from other code section of the IRS. Like, for example, if you're creating a book, you don't get taxed at the time you're done authoring the book. You get taxed at the time you sell that to an actual person.
Sure.
Other example, if you're mining, like let's say minerals out of the ground, you don't get taxed at the time you take those minerals out of the ground. You get taxed at the time you're selling it. Same thing with the farmers. You don't get taxed at the time you see the harvest on the ground. You get taxed at the time you sell that harvest in a market. So they're applying that newly created property tax rules to staking. And what happened was that IRS actually accepted their argument, and IRS refunded whatever the extra taxes that they paid for that staking income. Rob, are you there?
Yeah, I just put you on big stream because people want to hear you. They don't want to look at me. All right, keep going. Sorry.
Makes sense. So IRS did accept their argument, and they refunded whatever the extra taxes the Jareds paid to the IRS. So it's a good ending for the Jareds. But Jareds declined to receive that refund because IRS failed to clarify the reason behind issuing that refund. And that reason is super important for Jareds, so they can make sure that IRS not going to come after them for the same reason in the future years. At the same time, Jareds want to set like a precedent so other stakers, as you know, there are a lot of stakers in the US and all over the world. So if we can get a reasoning from the IRS, other stakers can rely on that reasoning and not report staking income at the time of the receipt. So because IRS didn't give that reasoning, Jareds took it to the court because when there's a court proceeding, IRS has to give some reasoning, and that court ruling can be used as a precedent to not pay taxes at the time you receive the staking reward. So that's what's happening. It's a favorable movement towards a pro taxpayer type of result, but it's not finalized yet. So that's what I want you guys to know.
Yeah, and that makes sense. And then, of course, in this article, it does say that a bench trial is set for March 2023. So for this year, we're kind of aced out. So here's the question, and I don't know if you can answer this, but if you are my CPA, and I'm asking you, so Shihan, how do I play this? Do I report to the IRS the $10 billion I'm just kidding, the thousands of dollars that I got in rewards from from Cardano, from Solana, from Gensukishi, all these things that I have? Or do I just say, no, I'm not going to report that, and good luck finding me?
It really depends on like your risk tolerance, right? I mean, if you want to be a little bit aggressive, you can be like, okay, I'm fairly confident that the court ruling is going to be, taxpayer friendly. And you could also have the exact same situations like Jared, right? Maybe you did Tezos staking. So that kind of gives you like a more stronger argument to kind of follow the same type of ruling, even though that it's not necessarily a ruling, it's just a news because it's not a court proceeding yet. So if you want to be a little bit aggressive, maybe talk with your CPA and you can decide not to report staking income at the time you receive it, thinking that there's going to be a court ruling to support that in the future. Yeah. So or the conservative way is, just kind of keep doing what you are doing, meaning you're reporting staking income at the time you're receiving it. And starting next year, and hopefully this ruling comes out, and from that point onwards, you kind of you start reporting. You don't start reporting income at the time you receive those staking rewards.
Well, let me ask you
Yeah.
this. So here, because like what you said made a lot of sense. An actual physical miner doesn't have to pay any taxes for the precious metals that they dig out of the ground until they sell those precious metals. That makes complete sense. And it is the same thing. Now we're just talking about digital precious assets, essentially. So to me, in my mind, I'm like, this cannot be law. I will probably go a certain way with this one. I probably won't. And I think moving forward will be okay. But here's another question. What would be the penalty if I said, you know what, I don't want to, and then next year these Jarretts lose the case, it sets precedent, it is staked, and you have to report it? Would that be like a huge fine, or would it be like, okay, all right, now we have some clarity, here you go?
I mean, at that point, again, it depends. You had to see, if you want to go back and amend the return, right? That's the kind of right way to rectify things. In some cases, again, talk to your CPA. Like it might not even be worth amending the return because you probably had a little bit of staking income. Maybe because
it wasn't a big deal, right?
It wasn't a big deal, exactly.
Yeah.
And the other thing to remember is that either you report staking income today or staking income later, you still have to pay the same amount of, I guess, same amount of capital gains, like throughout the life span of that coin. So let me give it for example, because a lot of people think that, okay, like this is great, and so I'm not going to pay any taxes. That's not the way it works. So the conservative approach, you receive, let's say, one Cardano reward, let's say $5, and then you decide to report that as income. And later you sell that for $20. And when you later sell that for $20, you report income taxes on $15 worth of gain, right? $20 minus 5. That's the conservative thing. Now, let's say you want to follow Jarrett's, and at the time you receive that Cardano reward, you decide not to report any income. So that Cardano reward has zero basis. And when you later sell that for $20, you will report $20 worth of gains. So the total gain that you report is identical. It's just a timing. It's about when you pay taxes.
Right. So you know what? In my mind, what I'm thinking to myself is, I'm not reporting it. And then later on, if they say you have to, okay, that is a decision. Now I'll go forward and I'll pay my taxes. I mean, shoot, but I'm not going to just be like, hey, here you go. I know it's a gray area. So that's just me. Again, this is not what you should do watching, but that's what I will do. And Sheehan has probably his own ways to do it. Okay, so that's that part. Let's move on to something that I had no idea. This is a question I was thinking about. We did this video. It was about when I bought land in the sandbox, and I showed everybody how to the way to look for parcels and how to group the parcels and to get a better deal and things like that. And I didn't spend that much. I think it was just like 1 or 2 Ethereum. Now it's worth way more, right? So on that one, how does that work for virtual land versus physical land? Can I, because like on these physical plots right here, like on this house, I can claim depreciation over 30 years, and that is a tax deduction. And that's why, like, I always think that people should own some property, whether that be real or investment or whatever you want to do. But depreciation works out pretty good. Can I claim depreciation? I know it's funny, but you never know, on my virtual land. And how does that work because I bought that plot of land and it has appreciated greatly. So how does that work?
Yeah. So at a high level, virtual land is any type of digital property. Just think of it as a coin. So you have a cost basis, meaning how much you paid for it, and when you later sell it, you pay capital gain taxes. So it's unfortunately virtual land. You cannot depreciate land to begin with, for example. Even if it's non-virtual land, because in order for you to depreciate something, it has to have a useful life, and land has an unlimited life. So you can only, even in the non-virtual world, you can only depreciate buildings and etc. That's like a business or investment type of property. So the two things, just know that even though it's virtual land, like you cannot get any like additional benefits like depreciation. The other question that I get is, okay, it's virtual land, and in the non-virtual land or buildings, like you can do these 1031 exchanges, meaning
Right.
you can roll over the profits from one identical property to another and defer taxes. Can that be done in the virtual land? Not really, because that section 1031, the like-kind exchange treatment, is only applicable to real property. So unfortunately, virtual land is not real property.
I got you. Hey, how about this one? Okay, here, this is a little bit out base. Let's say you're on the virtual land, you buy virtual land, you put some type of structure in that virtual land. So in the sandbox, I'm going to have some place where I'm going to hang up my NFTs or something like that, right? And then I want to expand onto that, and I want to build different things. So let's just say, for example, that I want to make this really nice, and there's a new code that needs to be done. So I need to hire a developer to do this, to actually upgrade the different structure that I have in this virtual land. Could I use the developer as a tax write-off for and almost like depreciation? Would that be a possibility or no?
It is a possibility if you're using the virtual land as a trade-off basis, meaning like you bought the virtual land and you're literally trying to make profits out of building an exhibition center for your NFTs in the virtual land. So still, you cannot depreciate the building, because depreciation is applicable for like these, like hard structures, meaning real property. But anything that you spend on to get it ready to present your NFTs, meaning get it ready to have the building and or the graphics and etc. In other words, whatever the compensation that you pay for the developers, that could be a business deduction, because that's ordinary and necessary for you to get your bare land to the point that it's ready to exhibit like your NFTs.
Gotcha. You know what? I'm thinking about it, and we're going to move on. I don't want to delve on this, but like if I owned some type of virtual land in like Web 2, it has depreciated because everything's moving to Web 3. And I'm like, there is depreciation here. I will never win that argument, but I'm just saying that's what it is. So that's leads me to my next point. You wrote an article about Web 1, or actually on Web 3, and how things are moving into a wallet-based economy. I'm going to pull this up real quick so you can talk to us about it. This is going to get a little tricky. So let me go up here. And just to bring people back, so Web 1, just so you know, Web 1 was like the very early days of the internet. You had stuff like, you still had, Netscape, Internet Explorer, and MSN. So you still had Google, but it was read-only or decentralized. And I was like, really? It was decentralized? There was a great article. I'll link at the end. In the 90s, Web 1.0 was running on a fully decentralized infrastructure. And it says Web 1.0 was running on a fully decentralized infrastructure. Anyone could host a server, and every computer on the internet would act as a relay between browsers and servers. That's exactly what we're doing right now. And then, of course, Web 2 became stuff like this, where everything is just is hosting massive computer data centers and servers and things like that, and everything goes through a centralized locale. And now we're looking to go back to decentralized, where everything is based on just the decentralization process, different nodes, and it is hosted on people's computers, just like all the blockchain and Bitcoin and things like that. So what you wrote here was, you said the current financial system, let me blow this up. The current financial system built on Web 2 is centered around accounts. You start everything by signing up for an account, just like in Google, just like on Amazon, just like on every place. This account-based system makes you tax compliant by employing what's called the IRS document matching system. Third parties report your activity. So everybody out there, if you think that Coinbase isn't reporting your activity to the IRS, trust me, they are. And every different exchange, they're reporting it to those tax agencies, unless you live in a different place that don't, like Puerto Rico. Anyhow, this system, third-party information, actually works really well in an account-based economy, which, of course. However, Web3 is creating a wallet-based economy. In Web3, you start everything by creating a wallet as opposed to an account. Your identity is tied to your wallet, MetaMask, Phantom, not to a third party. Accounts care who you are, like in KYC, know your customers. Wallets don't care, because my MetaMask doesn't care who I am. Accounts are owned by a third party. Wallets are owned by you and me. Accounts make you tax compliant. Wallets don't care about taxes. In a pure wallet-based economy, tax enforcement will not work because your activity is not reported to the IRS by third parties found in an account-based economy. Pseudo-anonymous wallet holders have no incentive to report either. Simply, taxes are incompatible with Web3. And you said, I don't think that tax regulators have thought about the possibility of a wallet-based economy. So leading up to that, how is that going to work moving forward? Because it's an interesting concept that everything that we have in our MetaMask wallets, how are they going to know?
Yeah, so I think this is a major problem, and again, the regulators are super behind on this thing. I don't even see that regulators see these as like a potential challenge, because you could come up with all the tax rules, but then the question is how enforceable are they in a Web3 type of system? So my proposal, I just kind of, it was on the tweet as well. The only way to kind of, if it's like a pure wallet-based system, and by the way, I don't believe the world's ever going to be kind of binary. We are moving completely towards like a wallet-based economy. There will always be like centralized exchanges and etc. And people will still be using that because a lot of people they want to interact with simple platforms, and a lot of people are not super technical.
Sure.
So I think the way that the tax compliance is gonna work, again, I don't know the time period, maybe next 5 to 10 years, or maybe next 10 to 20 years, the regulators can directly police the the cash on and off ramps. That's pretty easy, right? Because if I'm uploading giving cash to Coinbase, then there could be some taxes that could be implemented at that point. Similarly, at the time you exit from that Web3 world to the real world through like a Coinbase or whatever the off ramp.
Yes.
So those are like two practical ways that regulators can work on. The other way is kind of embedding some type of small tax percentage to the transaction itself. So think about similar to paying gas fee. There's like a I don't know, like maybe like a global tax fee that goes to like a global tax DAO or something like that gets distributed to the countries all over the world. So those are like the ways that we can kind of make these wallet holders tax compliant while preserving their privacy.
I got to tell you, when I read that, a light bulb went off, and I was like, yeah, how are they gonna know that? Like, let's just say and I'm not saying this has ever happened, but let's just say that I have a MetaMask wallet and someone wants to pay me for a service, and they live in, I don't know, let's just say Spain. And they're like, hey, Rob, I want this service. Great. Well, send me over some, whatever, USDC. Sure, here's your USDC. All right. Well, I don't have to report any of that stuff. And I'm not saying that I won't, but I'm not saying that I will. But I'm just saying that those wallets, it's very, very difficult. And now I understand why the Biden administration and everything else, how they talk about crypto and digital assets are actually a national security issue, especially with what's going on in Russia and China and the digital ruble and the digital yuan. So it makes sense. Again, I don't know how they're going to do it, but I can tell you right now what I see. And I think you feel the same way, Shihan. America is vastly behind the ball on crypto and digital assets. Just my opinion.
Yeah, I agree. It's literally like me coming to your house and just handing you like a $100,000 worth of briefcase with notes inside.
Yeah.
It's really hard for anybody to track unless you go to a central third party like a bank or depository. Then it's gonna trigger some reporting. But in a wallet-based system, that's why in my example, if you're working for a DAO, you're getting paid through a cryptocurrency directly to a MetaMask account, and you never have to cash it out because you can buy your groceries, you can pay your rent and everything.
Yes.
In the metaverse. So then how is anybody going to know, right? So yeah,
exactly. That's awesome. Okay. So then lastly, we'll finish up and we'll get to everybody's questions. This one is about, there's a couple of things. First of all, exchanges and the tax forms. And then we're going to talk about the programs that you can use and tax minimization. Actually, let me get that out of the way first. That's probably the most important. So everybody out there who's a little bit uneasy about taxes, you got two options. First of all, CryptoTrader.tax, that's one that I use. There's a link in the description. It looks just like this. I even did a explainer video on how to use it. From the time I open it up, the time I get all my my integrations, my API integrations, it takes me 30 minutes. There's a direct integration to Voyager now. That's good for some of you who like Voyager. Also, it integrates with the DEXs and NFTs and things that you bought on OpenSea and stuff like that. So that's mine. Also, Sheehan works for a unicorn status company called Coin Tracker, and they do same types of services, a little bit different in way that they approach things, but there's options for everybody. And Coin Tracker is, of course, another option for you. And you can check that out, cointracker.io. So, Sheehan, talk to us about two things. First of all, tax forms from exchanges. What are we getting ready to do? And then how can we minimize these taxes legally? But after this, you can tell me illegal stuff if you want to, but legally on this one.
Yeah, so let me kind of go through what kind of tax forms you can expect to receive from these exchanges. Important topic because we are in the tax filing season.
Sure.
So number one, 1099 miscellaneous. If you earn any staking rewards in excess of $600 or any type of other type of rewards for completing certain activities and etc., you can go to the tax center of the exchange and you should be able to download this form, and that's obviously taxable income. You should see that on that form, and that goes on your tax return. The other form you might see, Rob, do you have any questions or?
No, go ahead.
Okay. So the second type of form you might see is the form 1099K. That form summarizes your monthly activity. It's not a taxpayer friendly form. It's the numbers over there is useless because it does not actually. Yeah, that would be great if you can put the form 10. That's, by the way, form 1099 miscellaneous. Form 1099K. So it kind of as soon as you receive it, you're going to be like, oh my god, these numbers are completely wrong. These numbers are super inflated. The reason is that this form does not report your cost basis. In other words, how much you paid for the coin. So if you ever receive this form, just make sure you connect your wallets and exchanges to a cryptocurrency tax software tool to kind of get the right numbers out of this form. Do not just put this form or whatever the numbers on this form with the tax return. If you do that, you're going to be overpaying your taxes big time.
Gotcha.
The third type of tax form you're going to see from some exchanges is the form 1099B. This is the form that you're going to get from like stock brokerages. Like, if you traded stuff in, Robinhood or TD Ameritrade, you're going to see this form. This form is actually useful in most cases. It shows your, cost basis. It shows your, sales price. But when it comes to crypto, and especially if you have multiple wallets and exchanges, the cost basis box going to be 0, or it's going to say missing cost basis.
Ugh.
And in that case, you're going to have to figure out the cost basis by using a crypto tax software tool, because if you do not report the cost basis, you're going to be overpaying taxes again. Yeah, so those are the three tax forms. And I would say the number 4 is, there are some exchanges, they don't issue any type of, formal tax forms, and they just give you the transaction history report. It's complicated. Like, you're going to see thousands of lines.
Yeah, I never liked that one.
Yeah, it's really hard to figure out your taxes by looking at that. So again, you're probably going to have to use a crypto tax software tool to kind of convert that report into a taxable gain or loss report. And then the last one, finally, if you're using like these Web3 type of protocols, like could be Uniswap, OpenSea, or MetaMask, you're not going to get any type of reports whatsoever. So in that case, you will definitely need a crypto tax software tool, and you can connect your MetaMask or OpenSea directly there, and the software can kind of figure out what your Ethereum address has been doing and kind of convert that into capital gains and capital losses. So those are the 5 types of things you can expect this tax season.
Perfect. Okay, so that takes care of that part. So we're all in compliance. No one wants. I was like, great, that's awful. Let's talk about how to minimize taxes, and this is important. And I know there's different things. There's tax loss harvesting, one of my favorites, and you can kind of do those things. And then what else can help us actually minimize these taxes?
Yeah, so I'll start with tax harvesting. So as you guys know, the market goes through ups and downs all the time. So if you got into, let's say, for example, I'll take Bitcoin. If you have Bitcoin and you pay $69,000, several months ago, you can sell that coin, harvest the loss, and get back into the same coin if you really believe in Bitcoin. So that harvesting that loss helps you, minimize your taxes. Meaning
Right.
that loss can offset your crypto capital gains and even stock, and even, in some cases W-2 and other types of income as well. So it's worthwhile for you to kind of sell these and harvest losses versus kind of continuing to hold them. And if you, it's good to be a hodler, but creating that loss kind of helps you offset your taxes.
Yeah. So Shian, here's a question real quick. So just so you know, what he's talking about is wash trading, essentially. And that is illegal to do in equities, correct? You can't sell your stocks and then buy them right back in a minute later. That's not how it works.
It's just to be clear, it's not illegal. You can still do it, but IRS going to disallow that loss because you did it without waiting 30 days. In the crypto space, you can do it like real quick, like, in the next second. But at the same time, I would be really cautious about doing stuff like that. I would at least wait, maybe a couple of days or 3 days, because there's this whole argument called, substance versus form. In simple terms, if you're selling something to create a loss, and on the next second, if you're buying back the same thing, IRS could say that, hey, you're actually trying to create artificial losses. So therefore, even though you can do that, in your specific case, you literally did that to create an artificial loss because you didn't even wait like a second to buy back.
Exactly. Yeah.
Yeah. So make sure you give like a reasonable time period before you buy back. Yeah.
Gotcha. And then, so here's another question. So like right now, because we're in 2022, anything we do right now for that specific type of action, we can't use that as a loss in 2021, right? That would only apply to this year, 2022. So if you were going to do that for last year's taxes, that's when you would do it. Now, right now, when everything was going down and things like that, that would have been a good time to actually sell and wait a day or so, like Shian was talking about, and then buy it right back. Take those losses on paper. And of course, there's transaction fees depending on where you go to, but then you have those losses locked in. So that's a good strategy. What else also, Shihan, can we do for tax minimization?
Yeah, the other easy ones are like, if you really need to cash out, make sure you sell the long-term coins first, meaning the coins you have held for more than 12 months, because those coins are subject to a more favorable tax rate than the coins you purchased within the last 12 months. There are some software tools that's going to kind of help you identify, what are your long-term coins, so you can sell them if you really need to cash out. The other stuff that you can do, like this is like kind of like a big move, but it's going to save you a bunch of taxes, especially if you have a lot of gains. If you live in a high tax state like California, New York, Connecticut, New Jersey, you can go to a state like Texas or Florida with no state income tax, and obviously you have to establish your residency there, and you can cash out your crypto positions, and those gains would not be subject to any state level income tax because those states don't have any taxes. So for example, just to give you some numbers, like if you're a high net worth individual in California, you got to pay federal taxes up to 37%. And then the highest California tax rate is like 13 point something percent. So if you go to Texas, you can easily save that, 13% state level taxes that you would have otherwise paid.
Yeah, makes sense. Yeah, so that's a good one for the US. And then is there any other thing that we can do to kind of, so of course, just to recap, make sure that you sell the ones that you've held the longest, because you don't want to pay short-term capital gains, less than a year. Everything over a year is good to go. Is there anything else we can do to kind of minimize these types of things besides moving to Portugal or Puerto Rico or Abu Dhabi or something like that?
Yeah, so the other ones are like, I know, Rob, like you're always talking about self-directed IRAs. You can, trade cryptocurrency in a self-directed Roth IRA. So you can combine your capital gains and everything inside that account, and you don't have to pay taxes today. And if it's a Roth IRA, you pay taxes. You don't pay taxes at the time you get that money out either, as long as you qualify the correct age requirement.
You know what? Perfect. And before we get to the Q&A, so thanks, Shian, for all those questions. I had a question yesterday from somebody who said, hey, would a Roth IRA make sense for me because I'm 61 years old? And I was like, and I was thinking about it, I was like, well, I mean, because you're over 59 and a half years old. So anything you put in the Roth IRA, wouldn't that be tax free if it appreciates? Like, so let's say he puts Bitcoin at 44,000. He's 61 years old. He waits 4 years. At 65 years old, Bitcoin is $1 million. Let's just say, I'm not giving a prediction. Would he have to pay taxes on that if he puts it in his Roth IRA?
I don't know if there's an age requirement to set up a Roth IRA. I had to get back to you on that.
Yeah,
I
didn't know.
Yeah.
But wouldn't that be great? Like you're like 6, you're like, I want to go tax free, and you just open a Roth IRA and you can. What's great about these Roth IRAs, and of course, there's a link in the description. I Trust Capital. It's up right above Sheehan. There is that you can do all the trades you want within that Roth IRA. If you think Bitcoin's going to crash, you could sell your Bitcoin for cash in that Roth IRA. You could sit on it as it went from 69 to 33, buy Bitcoin back, and you would pay, again, 0 capital gains tax. That's, I think, the coolest thing. I don't do that because I don't trade and I'm not that smart. So that's what we have for today. Sheehan, thanks for coming by. We appreciate it. Let's get to some people's questions, and hopefully I need to remind myself to remind people to hold their questions till the end, because I know everybody's got some pretty good questions. So let me turn off this banner. This is the fun part. I like this part. This is fun. Cal stinks. I'm ready to leave. Yeah, I don't blame you. I don't know what the tax rate is, but I want to say it's above 8% for capital gains tax. And I think it might be going up. Let's see. Jay says you both are amazing. Thank you. We appreciate it. That's nice of you. This one I can't pull up, but it says, amazing content, Dan and Sheehan. I've been doing the majority of my trading on an exchange that doesn't require KYC from U.S. residents. Can the IRS see those trades? Wink, wink. That's a good question. I have no idea.
It's a good question. Obviously, IRS has ways to figure out who owns certain wallets and etc. Even without that KYC information, there have been a bunch of cases that IRS has been successful because they have access to tools like chain analysis and stuff like that. So yeah. I wouldn't encourage you not to report anything because the exchange is not doing KYC. If you're still moving around money, there are certain type of reports that could get triggered at the bank level, and so I wouldn't be. It would not be safe for you to not report anything. So I'll leave that.
Yeah, I would think like this, and this is just me brainstorming. Not that I'm doing this, but I'm just saying, let's say you've got an exchange over in Kazakhstan, I don't know, and you're doing all the things. There's no KYC, and then all of a sudden you're like, hey, I want to take $100 out today, and it goes into your bank account. I don't know if they'd be able to track. I mean, we know that the IRS is pretty much triggered for bank accounts of over $10,000, but I'm not telling you what to do, and I don't want to get the Digital Asset News channel just taken away because I'm like, hey, this guy's giving out advice. But I'm just saying, I don't know how they would do that, but maybe they have some superpowers. Who knows? Mullet's here. Can't sell on a wallet. Yeah, that's true. That's a good point. Let's see. Thank you, Rob and Sheehan. Thank you. And then this is take the risk. It will cost you more than what I'm not sure about that one. Oh, here's a good one. My brother just moved from New York to Japan. Same pay, but takes home much more than before. I don't know what the taxes are in Japan. Maybe that'd be a good plan. I'm not going to move there, so who knows? How about this one? How is it considered when you buy NFTs with crypto assets? How would they distinguish that? Buy NFTs with Ethereum or any other coin? So when you buy the NFT, would that be let's say you buy Ethereum at $100. Now it's $3,000. You buy an NFT for one Ethereum. That's $3,000. Is that a taxable event at that point?
It is a taxable event. You got to you had to pay taxes on the $2,900 worth of profits.
Let's see. Here's another one. Jason says, any thoughts on the charitable remainder trust as an exit strategy? Now, I've heard this before. Charitable remainders or charitable organizations that you can set up and you put it into a charity nonprofit organization. But how does that work for charity? Let's say I bought Ethereum for $100, and then it goes to $3,000, and then I contribute that $3,000 to the Humane Society. How does that work?
Yeah, so in that case, you get a tax deduction for $3,000 because that's the market value at the time you're donating your coin to the charity. So you get the $3,000 tax deduction, and you do not have to pay the capital gain tax on the appreciation. So that's the advantage there.
Gotcha. And then I was thinking about a question. Let's say that gifts. So how does that work? Let's say, again, same example, $100 for Ethereum goes up to $3,000. I give it to my wife. Can I give an unlimited amount of gifts, or is there a cutoff, or there is no gifts I can give away as far as tax reasons? And how many times can I do that?
You can give away gifts so you can give up to $15,000 every year as a gift for unlimited number of people. As long as it's below 15,000, you don't have to even report anything. If it's above 15,000, again, there's no taxation for you nor the recipient. But if it's more than 50,000, you have to file like a tax form called Form 709, disclosing the stuff about the gifts and when you gifted it, etc. But generally speaking, receiving a gift is not a taxable event. Giving a gift to somebody else is not a taxable event either.
Interesting.
But the other thing is that you really have to know what a gift is for IRS purposes. Gift is something that you give it to somebody else without expecting anything back. If you're expecting something back, then it's not a gift. Then it's a disposition event that could trigger a taxable event. So
I'm good. Well, I think my wife's gonna be pretty happy. Someone's gonna gift this year. All right. So there's another question here. What about a rug pull? How do you report? Because there's been tons of those on the DeFi apps. How do you report that in the tax form? Can you report in the tax form?
Yeah, it's kind of like a gray area because there was this act called Tax Cuts and Jobs Act, which passed in 2017, and that restricted people from claiming theft losses on the taxes.
Yeah.
So again, first of all, we had to figure out, what type of loss is that? I mean, if it's a theft loss, if somebody hacks you or something, it's unlikely that you can claim that. But at the same time, I have seen, some people claiming rug pull as like a investment loss, meaning like if you invested $3,000 and now the coin value is zero, they will report, 3,000 as a capital loss. But the problem is that in order for you to report a capital loss, there has to be an exchange of something. Here, you had a coin, it went to zero.
Yeah.
There's no exchange. You didn't sell it to anybody. So that's why I said it's kind of like a gray area. I've seen people doing it both ways.
This is a prime example. Here's my example. So I had Steve Ehrlich, who was the CEO of Voyager, on, and everybody was saying, hey, we want to open up the token swap because we got screwed and we weren't around for it. And it was open for 9 months, so I don't know what to tell you. But I made a mistake on my Zero token. Zero token had the exact same thing. It was a token swap for a token called Relay. I took my eye off it for months. I didn't really care about it, just let it sit. And then they had a token swap in 45 days. I missed the window and I lost a good $10,000. And I was really ticked off, but it was my fault because, it's me. That's the one. So now I'm thinking about this, and right now it's worth 0.001 cents or something like that. Are you saying if I sell this to somebody, like to an exchange or whatever else, then I can claim those losses?
Yeah, then it would be considered a capital loss. Yep.
Oh, I will be doing that today. Well, I can do it I can do it today, but it'll have to be for taxes this year, which kind of sucks.
Yeah.
Here's another good question. I can't bring it up. It's from Pompano Mike, and he says, "Does interest received from Voyager or Celsius and other exchanges fall under staking?" So these are interest that you get from the APY from the crypto that you have on those platforms. Is that a staking rule? Because they're sending out 1099s. Is this interest and staking different?
Interest and staking are different because staking is based on some type of proof of stake mechanism, and it's actually according to what the information that was in that code case that we described, you're creating actual new property. But in the case of interest, you're not actually creating new property, like you're getting pieces of property that already exist. That's a taxable event unless somebody argues that point. Again, these are all gray areas, so people if you have deep pockets, you can argue with the IRS, and sometimes you can end up like Jared's.
You know what? I guess it would be how they pay you in APY. Because I think on Voyager, like I put DOT in there. DOT is at 12% APY. So that's the interest that I get. And they do what they do with DOT, which would be they will lend it out. They can rehypothecate whatever else they want to. Then they give me the yield on that, which just adds to my DOT position. So it actually comes back. But the other places that they give it to you in like DAI, I think in Celsius, correct me if I'm wrong in the comments, but they give it to you back in DAI or in like kind, or I think other places it's the US dollar. I would understand that if it's the US dollar, then definitely you're going to pay. But if it comes back to you in the same crypto, how would that work, Shihan? Does that make sense?
Yeah. So I think there's some confusion with marketing terms, right? I mean, sometimes, some of these platforms, they're like, okay, I'm giving you interest, but it's actually like a staking reward. So first of all, find out exactly what they're doing after you give them the money. I mean, if it's a staking reward that you're receiving, again, you could make the argument like Jared's that I'm receiving newly created property, so I shouldn't be taxed on that. Again, it's not a finalized case, but that's an ongoing thing. On the other hand, if you're giving, like, for example, I do this, like, you can lend GUSD to Gemini, and Gemini is, lending it to other people. And in that case, I'm actually getting interest because GUSD, I'm not earning any staking reward. So in that case, it's interest. So that's clearly taxable at the time you're receiving it.
And then when they pay you back, do they pay you in GUSD? Or do they pay you in US dollar?
They pay me in GUSD. Yeah.
Which is the stable coin.
Which is stable coin, yeah.
Okay. Yeah, okay, I get what you mean. So it's just the way they're doing it. Is it just interest or is it staking from the protocol itself? Okay.
Right.
Here's another good question. And how about taxes with strong token nodes? And I think this would be the same thing as like a Cardano node that you run or Cardano staking. I would think, correct me, and I know Mullet's got a couple of strong nodes, but I think that's how it works. Shihan, are you familiar with strong nodes and setting up nodes to gain? And do you get paid in strong token? That's the question.
I'm not exactly familiar with the strong nodes, but again, I want to reiterate this, that Jared's case is not finalized, but if you could make the argument that you're receiving some type of newly created token, you could rely on the Jared's argument, but it's risky because it's not a final court ruling yet. So
yeah, okay. So we'll see how it does. Let's see. IRS hates crypto. I don't think they hate it. I think the government's really excited about it because that's a lot of opportunity to tax the living tar out of people, and just to get some more money into it. That's what it is. Let's see. Oh, this is a good one. Can you split your gains in your tax return into capital gains and business income? I don't think that's.
No, it's not possible, unfortunately.
Yeah. Okay, how about this one? Which entity is best for a trader not considered a trader per the IRS? Because I guess to be considered a trader, you have to do this for a full-time job, thing like that. So would it be an LLC, an S Corp, C Corp?
So to be a trader,
yeah.
First of all, it's really hard to meet that criteria. You had to do trading, a certain number of trades every year, consistently throughout the year, and it has to be kind of your main source of income. So it's really hard to meet that bar under the IRS. If you think that you have a legit trading business, you could set up an LLC. LLC is a legal structure, so LLC could be taxed as S corporation or partnership or a bunch of other things. So I would set up an LLC. S corporation could work if you have at least 100,000 or more in income. Then you could see some tax savings compared to like a regular LLC.
Gotcha. How about this one? And then after this, we'll go another 5 minutes. So this has been a long one. We're almost going for an hour. So what about losses from trading?
If you have losses from trading as an investor, you can use that losses to offset your crypto capital gains and also stock capital gains.
Got you. And then here's the last two. So, well, first of all, when Mullet's, hold on, let me go down here. I think he answered this. I haven't seen this guy forever. Oh my God, this guy's a classic. XRP freak. He was always a troll. Spam is what you get on paid to pump channels like Rob's. Hey man, I missed you. Thanks for coming back. Let's see what else over here. This is oh man, sometimes I get nostalgic. I don't have the answer for the strong nodes yet, but there's 2 questions that I wanted to bring forth. Well, just one actually. And it's not a tax question, but do you think the U.S. is likely move the digital dollar to tax everyone accurately? And to me, I don't. Well, what do you think, Sheehan? I mean, can we really get the U.S. a digital U.S. dollar and they're going to tax everybody accurately and everybody will use it? I think that's very tough to do.
I think it's pretty tough. It's going to really raise like our privacy concerns and etc. as well. I think we are so far away from that type of thing.
Yeah, I don't know. All right. So now we're coming up to the last one. I think that is it. Oh, this is just a comment. I guess I'm 6 years old. I trust Roth IRA told me I have to wait something like 3 years to pull out without paying. Yeah, and someone else said 5 years. So I guess if you're 60 and you create a Roth IRA, you still got to wait some time frame before you pull it out. That makes sense, actually. Okay. All right. Sheehan, that's it, man. It's been an hour, and I know you got a lot of stuff because you're coming with tax times. You can't hire Sheehan anymore. He is moving into other realms, unicorn status. But I'm just saying, thanks, man, for coming back on. It really helps people because people get scared about taxes, and I don't blame them. I mean, they scare me sometimes, but they also make me angry. But I think it's just through education we can do a lot better. So, Sheehan, any last words of wisdom for everybody out there?
No, thanks for having me, Rob. And if anybody needs any introductions to accountants, I'm happy to do so. Just reach out to me on Twitter.
Great. And then let me pull up your information again so people can see it. You can follow him over at the Crypto CPA, or you can just look at my timeline. I'm always talking to him on Twitter. So just go to Twitter. It's the easiest way to find Sheehan. That's it. So Sheehan, thanks for coming by. Hey, stick around. We'll talk about the illegal stuff that we can't tell these guys. I'm just kidding. All right, everybody, thanks so much. Appreciate it. Thumbs up and subscribe. I'll see you guys in the next one. Adios.
See you.